Hey everyone, Ben here. A billionaire investor dubbed the next Warren Buffett has just bought 4 brand new stocks. So in this video, I'm going to dive into these stocks, exactly what are these stocks and what this value investor could be thinking when he's purchasing these downtrodden stocks. These could be potential 4 to 5x opportunities. They could be potential rebounds for the contrarian investor. Now, in this crazy market we're in right now, so many tech stocks, EV stocks, SPAC stocks, they're so overpriced and overvalued. This could offer a potential opportunity for a true value investor. But before we dive right in, if you're new around here, why not consider joining the investing family by hitting that subscribe button and turning that notification bell on. If you do find any value in this video at all, feel free to give it a big thumbs up. That helps out tremendously with the YouTube AI. And if you do want to know exactly which stocks I'm buying, which stocks I'm selling, and access my entire investment portfolio and join a thriving investing community, then feel free to check out that first link in the description below for the VIP membership family. And with that being said, let's dive in. So here's the guy I'm talking about. His name is Seth Klarman, the billionaire investor dubbed the next Warren Buffett. He even wrote a book called The Margin of Safety. Now, if you want to check out all my investing books, I've actually created an Amazon store after many requests with all my different and favorite investing books in there. So I'll leave a link for that in the description. It will most likely be near the bottom of the description. So let's dive into the latest trade. So we're here on Guru Focus. Now, this is a popular platform. It has all the gurus, which are legendary investors, latest trades according to their SEC filing. So every investment firm with over, I believe, $100 million under management must complete an SEC filing outlining exactly which stocks they've been buying and selling. So in this case, we've got Seth Klarman's here. If you guys want to check out Guru Focus, I've got a link for that also in the description below. So the first one we're going to look at is a very popular company. You'll all know this company, and that is Intel, real downtrodden company, true value play. So this was a new buy. It's currently up by around 8%. Seth Klarman, the legendary investor, paid around $48 on average. The price is at around $60 at the moment, so it's up around 26%. Now, I could go into detail about Intel, but personally, they're having a lot of manufacturing issues, which is why the stock is down. They're really behind the curve when it comes to manufacturing the newest generation of chips, and that's why the stock is down. Personally, I think it could be a potential value play, but I think there's other opportunities out there. So I'm not going to dive into Intel in this video. I covered Intel a while back during the actual dip. The other two we're going to look at is quite interesting. This is quite funny. Shows great minds think alike. So I actually covered this stock here, Reinvent Technology Partners Z, and the other one Seth Klarman has purchased is Reinvent Technology Partners RTP. Now, these are 2 SPAC companies, and it may sound, okay, what are these companies, Ben? Well, I actually covered both these companies in previous videos, and I stated I was taking positions in both these companies. And basically, these are SPAC companies ran by LinkedIn co-founder Reid Hoffman, who's a legendary person. Basically, everything this guy touches turns to gold. He was one of the earliest investors into Facebook. So this is Reid Hoffman's investment SPAC, and basically they plan to be merging, RTP plans to be merging with Joby Aviation, an urban air mobility company. Now, I did a full video on that company, so I'll leave that in the description below. I'm not going to dive into that company in this video. What I want to concentrate on in this video is this stock right here. This is Advantage Solutions, ticker symbol ADV. Now, this might not seem as interesting as an urban air mobility stock, a flying taxi stock, but this is where we can find real value. And there's a reason I'm saying this. So this is a new buy by Seth Klarman. But let's see how much he paid for this stock. Well, he paid on average $10 for this stock. And what's the share price right now? $10. So basically, we could be getting a similar opportunity to Seth Klarman. And I know Seth Klarman believes in a margin of safety when investing. So he finds out the value of a stock and he invests below that value in order to give himself a margin of safety. This is the Warren Buffett philosophy, and even wrote a book on it, Seth Klarman did, called The Margin of Safety. So this stock, if he's purchased it, I'm assuming must have a margin of safety. But it is a value stock. There's a reason stocks are value stocks, and that's usually due to some major issues with the business. Stocks are not cheap in the market for no reason. So we're going to dive into this company, exactly what this company does, why it's cheap at the moment, and if it could be a potential value play and a potential free bagger. So firstly, what does this company actually do? Well, the company is called Advantage Solutions. So this basically is a sales and marketing company focusing on major brands. So basically, if you want to sell any product at scale, chances are you're going to be partnered with Advantage Solutions. So here's a company snapshot for Advantage Solutions. Over 3,500 clients, over 58,000 associates, 400 plus data analytics professionals across 200,000 retail outlets. Select brands PepsiCo, Zillow, AT&T, Mars. Retailers, now this is the key. This company is partnered with retailers such as Walmart, Costco, Target, Home Depot, Whole Foods, Amazon, Kroger, and many, many more. So this company is really the perfect company if you want to sell any product at scale. It's got the sales and it's got the marketing. You may have seen this company working with experience or sampling services in stores. So when you go into a major store like Walmart or even Sainsbury's in the UK, you will see these people with sampling stores where they can offer you samples of certain products to try and taste. Chances are that that would have been run by Advantage Solutions. Now, of course, you can see the problem with this. That part of the business would have been hit majorly by the whole global lockdown, because would you want to be going up to someone and sampling products when we're all supposed to be social distancing? But if you have faith that this could recover and things will get completely back to normal, then this could be a potential value investment or a contrarian play. Now, the reason this is interesting is because when you first think about this company, you think, whoa, I don't want to touch that company. Involved with brick and mortar retailers, involved with experiences for marketing, which are actually interacting with people, which we're not supposed to do. Whoa, I'm staying away. And that's what Wall Street's done with this stock. They're staying away from this stock. But Seth Klarman is a value investor. He's a contrarian investor. He sees what the crowd thinks and then he does the opposite, but only if he has an information edge. So we're trusting him a little bit on this, but we're going to dive into a little bit more so we can make our own investing decisions, because that's what it's about. This video is not financial advice. So let's dive right into the share price, and you can see the major sort of volatility in this stock. Now, despite this company being founded back in 1987, so a long time ago, it actually only went public recently, I believe, via a reverse SPAC merger. It did shoot up quite a lot, and by 60% between November and December, 60% increase. However, now it's down by 25%. I believe that was due to a bad quarter. The market cap for this company is $3.18 billion, so still quite small. If you compare this to some of these SPACs we've been looking at with no revenue, they have a $3 billion, $6 billion valuation, and they've got no revenue. This company has a lot of revenue, and we're going to dive into that. $783 million for the third quarter of 2020, representing a decline. Now, this is the issue with this company, and this is why the stock also declined, of $197 million, or 20% from the same period in 2019. So compared to 2019, this company's revenue has declined by 20%. That's a major issue. However, they have seen growth of 22% from the second quarter. So things are improving. Of course, the first and second quarter, things were a lot worse in terms of lockdowns. I'm assuming the company's experience side of this business would be completely shut down. Operating income was $88.6 million in the third quarter, representing a growth of $12 million or 15% from the same period. So that's actually quite good. So they've seen a growth in operating income. Perhaps that was due to lower expenses from part of their business being shut down, but still not too bad. Net income was $36.7 million, representing a growth of 61%. Now that's extremely good. 61% net income growth. So that's something that we need to look at here. It's a value stock. They're going through tough times, but they're still experiencing growth in the net income, which is great to see. Now, there is another issue with this business. Business has got a lot of issues, and it makes you think, why did he invest into it? But he must have an angle, and I'm assuming the angle is about the reopening of these stores and these experiences. Company's cash was around $486 million. Total debt, wait for it, guys, $3.3 billion in debt. Now, the company's market cap's around $3 billion, to put that in perspective. So a lot of debt this company has. So that means net debt minus in the cash is around $2.8 billion. That is a lot of debt. This company's got a lot of debt. However, the company's been doing a lot of acquisitions. So if this company was really in a difficult financial situation, I can't imagine it wanting to do all these acquisitions. But it's recently done an acquisition of this company here, Conyers Park 2, which was a SPAC, which is, I believe, how the company actually went public. Correct me if I'm wrong, guys, in the comments below. This is just what I'm assuming so far. net debt outstanding was reduced to approximately 2 billion. So they have been reducing the debt, and they do plan to reduce the debt, which is why the company has gone public. Now, let's dive into a few key metrics, because this is what you guys will like. Forward PE, so price to earnings ratio, not price to sales, price to earnings, because this company is profitable. It has real earnings, guys. This is not a new SPAC with that's unprofitable, a young growth company. This company has earnings. Wow, I'm just so shocked. Forward PE of just 13.7. To put that in perspective, the S&P 500 average is usually around 25. So 13 on the forward price to earnings ratio is a value investment. PEG ratio, now this is what I like to see, which is the price to earnings growth ratio. This is 1.48. That's not too bad. Generally, I look for below 1, and that makes it a true growth stock at a fair valuation, but 1.48 is not too bad. Price to sales, though, to date, 0.94. So you're paying less than 1 times the company's sales. Now, to put that in perspective, a lot of companies will look at, they've probably got 30 times sales, 10 times sales, so you're paying 10 times company sales. This company's got 0.94. A brief look at the management of this company. So first, we've got Tanya Domier, Chief Executive Officer, 29 years of experience at the company. Sits on the board of directors of Yum Brands, Nordstrom, and Enactus. Now, Yum Brands is KFC and many other sort of food brands, exceptional sort of company and business. So she sits on the board of directors for that company, which is great to see. The next guy we're going to look at, the next person we're going to look at, shall I say, is Jim Kilts, the executive chairman. And he's the former chairman of Gillette, one of Warren Buffett's favorite companies, favorite investments. Former head of Kraft Foods and General Foods, which I believe are clients for this company. So I think really the unique thing about this guy is he's got great connections with his customers, with these big brands, these CEOs of Walmart and all these Kraft Foods and all these big brands. He can basically call them up at any time and they can help out with the business's operations. This is an assumption I'm making here, guys, but it seems that way from the company's connections. The company also has highly recurring revenue, which is really surprising. So client and customer average retention rate is 98%. So these are long-term relationships this company has with these major brands. So that could be a competitive advantage, or a moat, as Warren Buffett likes to call it. And the company's strategy is that of mergers and acquisitions. This company just loves acquisitions. It loves shopping just as much as the customers in their client stores. So acquired over 60 businesses since 2014 at attractive prices. So this company keeps acquiring companies, which is interesting to see. Now, this company has a debt to EBITDA ratio of around 3.5 after that occurred. To put things into perspective, a similar company in the industry, PepsiCo, which is also based in the consumer goods industry, also has a debt to EBITDA of around 3.18. So very similar levels. So it might seem high, but for that industry, it's probably not too bad. So half the business revenue is from sales and half is from marketing. That's great to see, diversified revenue base. So 2 billion in revenue from sales and 1.8 billion from marketing. Number 1 market share position. So this is the number 1 market leader for these consumer goods stores, these big supermarket stores. This is the number 1 leader for sales and marketing for those stores. So here's these relationships. This could be a competitive advantage for the company, a moat for the company. Length of relationships, around 25 years, 15 years for major companies. Unilever here, PepsiCo, GSK, Costco, Kroger, Walmart. Many, many years this company has been involved with these companies. Whole Foods, Home Depot, 25 years plus. Those are long relationships, and that's revenue compound annual growth rate, 12.6%. That's not too bad. Generally, I say a growth stock is one which is growing around 15% on the revenues. Now, this is not a growth stock, it's a value stock, but it's still growing at 12.6%, so that's actually quite good. EBITDA margin around 11%. Now, this is what we need to look at, and this is the issue with this stock, and this is why being a contrarian investor and a value investor, you're betting against what other people would say is common sense. So, of course, a major part of this company's store is shut down. The experiential part of the store, in-store sampling, virtual sampling, and events. Temporary disruption. So that's what we need to look at. And they're hoping after this whole situation is over, that will just get back to normal. We'll see what happens, but that's the risk with this company. That's the big risk we can see right now. The rest of the business seems okay. I could also imagine a bit of disruption from the online parts of different businesses. I know Walmart's got an online section, but still, I can still imagine a bit of disruption from other online e-commerce brands. So extremely interesting company there. You guys have asked for a value stock many times before. I always cover growth stocks. This is probably one of the few value stocks I'm going to cover on this channel, and it could be a very interesting play. So the positives of the company: great price to earnings ratio, great growth. They've had a bad quarter. They've had a bad year because it's 2020. Part of their business is shut down, the sampling part of the business, but they have very strong relationships, 25 years plus, with major retailers: Walmart, Costco, Amazon, Target, and many, many more. So that could be a potential play. A great value investor, Seth Klarman, the next Warren Buffett, has invested into this company. The share price right now is at the same price he invested into this company, around $10 per share. So ticker symbol again for this company is ADV. If you guys want to check it out, this video is not financial advice. And if you guys want to know exactly which stocks I've been buying and selling, then feel free to check out that first link in the description below for the VIP membership group. You also get to access a thriving community of great investors and some of the best people on the internet. Also, if you guys found value in this video, feel free to give it a big thumbs up. Let me know if you want more growth stocks or more value stocks and what you'd like to see more of. And also, if you haven't subscribed yet, feel free to join the investing family by hitting that subscribe button and turning that notification bell on. With that being said, I hope you guys have an incredible day, and I'll see you in my next video. Invest safe.